The Fed has signaled plans to gradually increase interest rates this year. We're with Ken Fincher, a portfolio manager at First Trust Advisors, to talk about possible implications. Ken, how does a rising rate scenario affect current closed-end fund investors?
Well, it's important for investors to remember that most closed-end funds utilize leverage. And in leverage, what they're doing is they're borrowing short and they're investing long. So the cost of leverage, when you start to see rates move up on the short end of the curve, will narrow the differential between the long and short end, which means that the common share or the investor for the common shares may not be able to get as much of a bump from the leverage on side of a portfolio. So that draws concern into closed-end funds.
We've had a relatively low interest rate for years, and many investors may have turned to closed-end funds in search of higher yields. Will closed-end funds lose their attractiveness to new investors?
The higher yields will still be there, and there will be a period of transition for many funds as their cost of leverage moves higher. But that said, the nice thing about the closed-end fund wrapper is the sense that managers can be opportunistic in terms of getting involved in the secondary market. So they don't have to always meet cash requirements to meet redemptions on their funds. And so as rates start to move up, and even if rates move up on the long side of the curve, they can actually go back and reinvest proceeds, and eventually it will move everything higher. So while leverage will be an issue in the months leading up to more rate increases, in the long term, it will play well into the common shareholders.
Given the rising rate environment, what sectors of the closed-end fund market may potentially present opportunity for more sustainable cash flow in the future?
What we've seen is a lot of investors moving towards shorter duration type of portfolios, and we've even seen that in the IPO process. On the short end of the curve, what investors are really focusing in the taxable fixed income side has been senior loans and short duration high yield funds. However, as I mentioned in the IPO process, what you started to see is sponsors bringing out term trust or funds that have finite lives. Many of these funds have been brought to market and have 5 to 7 year lives, and so the investment parameters prohibit them from going beyond that.
Summing up, what do investors need to keep an eye on, and how should they consider responding to the challenge of rising interest rates?
The key for investors now is patience. Many retail investors, when they start to see rates rise or they start to see their distributions move lower, they tend to panic and they tend to sell out ahead of when they should. So they sell into the weakness. Take a long-term perspective. If you bought the fund and you like the fund, one rate increase is not going to impact you all that much. Don't sell into the weakness, wait for funds to rebound, and if you still think you need to sell, the time to sell is when you start to see a little strength come back into that sector.